String of strong economic data reshaping Wall Street's debate over the timing of the next rate cut. Last week, Fed Chair Jay Powell signaled that he wasn't in a rush, saying that there's no need for policymakers to be, quote, in a hurry to lower rates. Those signs of hesitancy coming as Wall Street attempts to game out how inflationary President-elect Trump's push for tax cuts and his push for higher tariffs could potentially be for the economy. Joining us now to discuss, we want to bring in Jeffrey Roach. He's LPL Financial's chief economist. Jeffrey, it's great to have you back here on Yahoo Finance. Talk to me just about how you're looking at the prospects of this and how you see Trump's potential policy here influencing the timing of rate cuts.
Right. Well, there has been a lot of unknowns really starting back in August going into the September decision that the Fed had. Of course, as you remember, a jumbo supersized cut, 50 basis point cut, then a little bit risque in that sense, a little bit more than what markets expected. And now the pendulum has swung perhaps a little bit to the other extreme with the no hurry comment recently from last week. I think it boils down to this. The Fed has to accept that data dependency has its inherent risks, right? Especially when you throw in data revisions to that. And so, I think at this point, it's going to be a little bit choppy when in addition to what I already mentioned, you had weather related disruptions. So that's going to be a little bit of a tough time interpreting the next upcoming payroll report. I think it's going to be hard for a December cut for a couple of reasons. Is the payroll number might actually be a little bit hotter than quote unquote it should be, given the fact of payback from the previous month. And you might have a little bit of those base effects giving our inflation data a little bit hotter, not necessarily a change in trend, but perhaps some of those month-on-month numbers are going to come in a little bit hotter. So that's going to put a little bit of headwind, I think, for those expecting a December cut. Although at this point, it's somewhat of a coin flip.
So what does that mean for where you see the neutral rate more long term? Neil Kashkari spoke with Yahoo Finance's Jennifer Schomburger at our Invest event, and he talked about how the just resilience of the consumer combined with some impacts from the incoming administration could require a higher neutral rate. What is your take on that?
Well, I think the neutral rate could be a little bit higher, and I think we actually see that when we read the previous summary of economic projections. Fed releases those periodically, not after every meeting. We'll get an updated summary after the December meeting, but we've seen them slowly inch up, 2.8 to 2.9 to 3.0 perhaps. I think one of the things that could argue for a slightly higher long run rate is the fact that the millennials are already starting to reach their peak spending, peak earning stage. They're probably going to be the beneficiaries of this greatest wealth transfer in history that we're talking about from the silent generation and baby boomers passing on inheritance. This is probably a longer term trend that we have these millennials becoming a greater powerhouse in consumer spending, and perhaps the consumer and the strength of the consumer might last a little bit longer. And I would not be surprised if there's more and more conversations that long run rate needs to be a little bit higher, but still hover around 3%.
So then what are your expectations then in the short term for this fight to tame inflation? We certainly have seems, at least maybe for now, the latest wave might be more of a head fake than anything that really materializes. Is that going to continue then to be the case, do you think?
Well, I think the Fed is probably going to embrace this cut and pause cadence where they perhaps pause in December, but if they do cut in December, they're definitely going to pause in January. So the cut and pause, making sure that these slight upticks in the annual metrics of inflation are certainly head fakes, not necessarily a change in trend. Now, granted, tariffs and the risks of that certainly throwing a wrench in forecasts. But at this point, think of it as a cut and pause cadence.